Welcome back to Good Returns. I'm Matt here with Garrett. Back in the studio, we got a full show, a lot to get into. Last week was one of the most important weeks on the market calendar all year. Told you to watch it closely, and it absolutely delivered on those interesting points and expectations that everybody had.
Did it?
Yes, it really did. It really did.
Well, Microsoft certainly had a big day. Biggest single day market cap gain for any stock in recorded history. Amazon reported the first $200 billion quarter ever. And then you had Meta that didn't perform as well. They fell. AI picture for earnings, no longer theoretical, we could probably say. Market seems to be sorting through actual, real, live, tangible results, company by company. And just because you're spending a lot on AI doesn't really mean that your stock price is going to appreciate much anymore, at least here in this time period that we're in.
Yeah, we've got an economy that looks a little softer on the surface than it's actually underneath. The Fed is still holding, but arguably some people would say sending mixed signals. I don't think they are. And a planning room today that we teased a couple of weeks ago on something that most people have not heard much about yet, I would say. I mean, probably not heard anything about it at all. But that could fundamentally change the way you move your money around. Think about the leap from, cash to a debit card. Something along those lines, maybe even an order of magnitude greater of a change. So very interesting things.
Yeah, tokenized deposits is what you're talking about. But we're going to explain what they are and why every major bank in the country is quietly building the infrastructure for them and what that might mean for you as an investor.
Yeah, and before we get into it, a quick note, as always, everything on Good Returns is for educational purposes only. Nothing we say is personalized financial advice. Always consult with a trusted advisor about your situation. And if you don't have one, go to momentumwealth.us, and we may very well become your trusted advisors. All right, let's get into it. Big week for markets. S&P 500 gained nearly 4% and set a new all-time high. The Dow, the equal weight S&P, and the Russell 2000 also hit records. The breadth this week was genuinely encouraging. Unlike the narrow tech-driven rallies we've been watching, this one had participation across the market. Also, just a little note there, if I was looking the other day at some performance metrics on different equity positions, and in looking at value, kind of the proxy we use for value positions, the year to date, which we've been overweight value this year more than we have in a very, very long time. And, it just was a nice little 15 or 20 minutes of taking and just looking at the historical data of values return. And so year to date, it's up over 20% for value, which we love to see again because we've been overweight value, which is one of the reasons why the equity positions in our portfolios, have really had a stellar, those equity positions have really had a stellar time period. But you're going to be hard pressed over the last 30 years to find a period where value outperformed that much. So it really tells you there are some structural changes that are occurring. Now, it's going to take time to really understand why, that is happening, because generally what you'll have is value outperforming during overall market weakness, but it's very rare that you have value outperforming during market strength. What does that mean? What does that mean for an expanding economy? What does it mean for the secular changes that are occurring, throughout the economy that could have knock-on and butterfly effects that we have spoken about with productivity increasing and what it means for companies whose names are not always in the news, such as NVIDIA or AMD or Dell or so Micron, so forth and so on. So it was very interesting to see that. But yes, equal weight S&P and the Russell 2000 also hitting records. So definitely broad participation. But tech did, in fact, lead.
Yeah, Magnificent Seven, if you're still keeping track of that. I don't know if you are or not. It's been kind of, is it the same Magnificent Seven? Do we say that? They gained.
Who knows these things?
They gained nearly 6.5% as the earnings picture clarified. You had consumer discretionary and services also performing strong. Energy, worst performing sector, down nearly 7% as oil fell back down towards 75, roughly where it stood before the last, what do we call it, a flare-up? Last flare-up in early July. Middle East situation swung again. U.S. planned a strike. They stopped the strike. Talks, no talks, straight open, not open. Really, in light of this, it really is amazing that we're back in the 70s for oil because nothing has really happened. I mean, there's not been any kind of concrete announcement. It's just all speculation.
Well, what's the terminology? Fog of war. I don't know if that would necessarily be applicable. We only know what we know, what's available to us through media channels or through independent reporting that comes out of that region. We really don't know what is closed and what's not closed. We really don't. We have no idea. So there could be a lot of.
Well, you can track the traffic.
Yeah, but the transponders are off. You're not tracking anything. So there are something is getting through, and so you just don't know how much is bluster and how much is not.
Yeah, there was some report that they were charging a premium for like safe passage through the strait at one point. I don't know. You're right. It's hit or miss. We only know what we know, which is not much. Because they keep like, will they, won't they? What did George Bush say? Fool me once, shame on you. Fool me twice, whatever.
Yeah, no, it's the oil is going to get out. It does not matter. You don't need to know anything else. It doesn't matter. It doesn't matter why. It doesn't matter what happens. It doesn't matter who's right, who's wrong. The oil will get out. That's all you have to know as an investor. The oil will flow. There's nothing you can do to stop it. Yes, it will get out, and it has, and it will continue. So everything else is for another pay grade, right? That's for policymakers. That's for negotiators. That's for all these other defense officials and such. But when it comes to being an investor, all you have to know is that oil wants so badly to find its way into your gas tank and into the factories of the world that it will absolutely flow. It is 100% guaranteed. It's going to happen. And it has happened. So,
and it's also interesting to see the lack of fluctuation in prices at the pump when all of this is happening. When it's going up and when it's going back down, you're not seeing that change in real time.
I don't know.
So that's an interesting part of it. I mean, why oil? There are people who, can pontificate on what oil should cost, or gasoline rather should cost, based on $75 oil prices, and it's significantly lower than where we're seeing it, at least here in Georgia. Maybe other people, it's a little cheaper in Louisiana, I think.
It's proximity to refining capacity, et cetera, I'm not quite sure. I will say that, generally when you're looking at the price, the WTI, that's a forward price. It's not the day's actual price. It's to take delivery 30, 60, 90 days out. That's definitely not our area of expertise. But what is our area of expertise is absolutely telling you from the beginning of this conflict to now, do not, what you can fade oil prices. You can fade it with a high degree of confidence. So it's becoming less interesting of a topic the more right, You
don't love talking about it every single week.
No, I mean you can only say you're right for so long before it just seems like you're bragging. I wouldn't want to do that. Bonds gained as yields fell.
I don't think I've ever heard you brag about anything.
Bonds gained as yields fell. This is actually in real time happening today as well. Shorter maturity government bonds outperformed. High yield corporates did well as credit spreads tightened, a sign of returning risk appetite. Now, we did have a little bit of a movement in gold, nothing really that I would call exciting, but there was a little bit of a movement that's showing that price action may be waking up a little bit after a multi-month slump. Volatility index declined and the dollar held steady.
We're seeing gold again today. Also silver. Both of those kind of pop in today. We've got let's see. up to over 2% today, as we're recording this. But I think we're up
7% since mid-June, I think.
Yeah, well, yeah, like 5% over a 30-day period, almost 5%.
Okay. Yeah, I mean, it's waking up a little bit. We will tell you this is not trading advice, but after we acted on this data point and the data that we track and how we build out and structure portfolios, gold was a risk off on gold. It was a negative indicator, still is negative. But it's interesting to see, generally it takes a decent amount of time, the way that we decide to allocate or not to allocate towards precious metals. It takes a decent amount of time to go from a negative to a positive. And it can happen quickly. It absolutely can. But generally speaking, it takes a decent amount of time. So we're not placing too much.
Yeah, and you have to understand where it came from too, because all of that said, the last 5 days we're up almost 8%. But if you expand that out to a year to date, it's basically flat. Gold is flat. We've got 6 month down 12%, 3 month down 7.5%. So this is good news. We would like to see this if you are sort of bullish for that metals sector, but at least from our perspective, I think what you're getting at is we're not necessarily buyers here yet.
Yeah. No, I would agree with that. The dollar was steady. We did see some intervention with the Federal Reserve, U.S. Treasury for the Bank of Japan in getting a more balanced value of the yen. So that is that intervention, kind of put a stop to the yen's appreciation or depreciation, relative to the dollar, allowing it to appreciate markedly over the last few days. It's really too early to look at knock-on effects and to see how long that swap line or that intervention continues. But my spidey senses are telling me we may have a very interesting and educational show coming up here in the next few months if that activity continues, and we can talk about the yen carry trade and what it means for it to, have a managed unwind.
We've seen it before
over a period of time. So yeah, the market did digest one of the busiest 2-day stretches on the calendar and came out of the other side at all-time highs. So, we've been talking about the AI spending debate and whether the hundreds of billions being invested in infrastructure would produce a return that justifies the cost. Last week, we started getting answers, and the answers diverged in a way that matters.
Yeah, based on, not spending alone. That's not what we're looking at anymore, or it's not what investors seem to be looking at. You had Microsoft Azure cloud business. They grew by 43%. That caused the stock to rise 16% in a single session, biggest single day gain in market value for any stock in recorded history. We talked about that at the top of the show, but Amazon also reporting its first ever $200 billion quarter, powered also by its cloud division. So both of these companies showing that that AI spending is producing measurable growing revenue in these certain areas of their company. And then the market rewarded them. And then, we had something completely different with Meta. You can tell us about that.
Yeah. And I have something interesting
but that's where the diversion comes into play.
For Meta went down. It fell. Okay. After its earnings. Despite heavy AI spending, the returns weren't as clear in the numbers. So, Meta isn't going away. It's not that bad, but the market is definitely applying a different standard. It wants to see the growth that justifies the spending. Microsoft showed it. Amazon showed it. Meta was less convincing. But I think that, I'll hold off on this for a second. But I think that the metrics upon which analysts and money managers are justifying the buy or the sell based on the numbers it could potentially be flawed. But
that kind of goes without saying. I'm sure it is. It's all happening in real time. You're having to digest this information. But I would argue that maybe SpaceX is in the same camp. They reported positive earnings during their first earnings report, and they're also spending a lot of money, and stock price fell. Yesterday, unlocked the first tranche of these newly minted millionaires that work at SpaceX and have the ability to sell their shares and realize that gain. And the stock price was up yesterday. The stock price is up again today. So this is very counterintuitive over what the narrative has been, which is that, we got to wait till this date that comes and everybody's going to sell all their SpaceX shares and the stock price is going to fall and we're going to get it at a really good price point. And it's just not necessarily what happens, because you also do have a lot of buyers. There are a lot of people that want access to SpaceX, for different reasons. So this is one of those times. Jim Cramer brought it up on his show. Actually, we always laugh about Jim Cramer because you have to be kind of a financial news nerd, but he tends to, when he says things, the opposite thing tends to happen. So when he made a comment about, buy SpaceX, I was like, oh boy, here we come. But didn't work out that way in this instance. Up over the past 2 days, double digits, right?
Yeah, it's up. It's kind of range bound in my opinion. I don't know. I think we've come out of the fluff of the IPO. If somebody wants to be a buyer at these prices, there's nothing wrong with that, especially if you're going to hold it for a long period of time. Could there be weakness? Absolutely, because you have a lot of unlock coming, and you also have people trying to, understand how this company makes money, to really understand both the enormous upside potential, but also the near-term risk. The amount of money that has to be spent for them to do what they want to do is enormous. And that could weigh and will weigh at certain periods of time on the stock price. And you have to be sober-minded about that, about those realities and how it affects your timeline of whether or not you enjoy that type of a ride. In speaking of, I think it's healthy to see markets being able to allocate capital where it earns the best returns. So the AI theme is real. The spending is real. The growth is real. And the companies, there are plenty of them are showing it. But it's not uniformly good for every company in the space forever. And so differentiation, diversification is how mature markets work. Now, I will say that the framework upon which a lot of the analysts, either for or against, the critics or the cheerleaders for some of these companies and how they're spending, AI, it may be wrong, because I think they may be looking at, you're going to spend $200 billion. How are you going to make that back in more like a linear, 20% compounded annual growth rate of software companies generally do. But Google's DeepMind chief strategy officer, posited that there's going to be an air pocket where you're going to have $100 billion data centers. That you're not going to immediately get the return on that immediately. But it's creating what they call a recursive AI moment, where as you build out these data centers and as you build out the algorithms, they become self-fulfilling and self-improving. That reduces the need for further capital expenditures in the same manner in the future, while allowing this constant, iterative, and improving intelligent system to solve real problems in the market in ways that we can't really, understand. That basically the goalpost really is not, how much will $200 billion buy you of a subscription model to ChatGPT over the next 5 or 10 years, and how many, people will be using this ChatGPT, but more or less understanding how a self-improving system, once built, can create this, exponential curve of value in ways that we can't possibly imagine right now. And it was very interesting, because it flips everything on its head. And when you start thinking of it that way, you start understanding, okay, well, that's why Google can spend $10 billion on one building and not think twice about it, and then build 20 of those, $10 billion buildings. It's because they're betting on not spending $200 billion to make, $30 billion a year extra. They're spending $200 billion to make maybe $20 trillion in revenue and in value. So it's going to be interesting, I think, as we go through this next 18 months, to see if even the criticisms of AI CapEx and the cheerleading of AI CapEx are really getting it all wrong. That they're not really looking at the exponential picture, which, I think is a great possibility, because as humans, it's hard for us to think exponentially. It's very, very difficult.
Well, it's been going on for a while, and we're kind of pivoting to the stage now where people want to kind of expect to be shown the fruit of their labor, so to speak, the fruit of their capital, I guess, in this instance. Because it's not, we've been in an environment now where, even normal companies that put AI in their name, they get a giant run up in their stock price. We've seen this time and again. I think we're moving forward from that, and I don't think that's a bad thing. I think that people wanting to see results, particularly investor wanting to see results from the spending that's going on, it's always a happy medium. I mean, you still have to be able to find the winners and the losers. You still have to find the companies that can deploy the capital responsibly and in the right areas, and they're not just peppering, every area they can find. And that's why you kind of saw this diversion between, Amazon and their cloud services, and Meta, and the fact that they're spending a lot of money, but they're not, their earnings are not where investors would like them to be. So it's just it's going to take some time to kind of flesh out what is actually happening. But it's interesting to see the change even in the last 12 to 18 months, like you were talking about, where you could pivot a shoe company to an AI company and have a 600% run up in their stock price just for that specific thing. Like, hey, we're going to pivot to AI. Oh, great. Yeah, let's throw all this money at you. And now that seems to be, we seem to have a little bit of a stronger barrier, which is a good thing, I think.
Yeah, it's fine. It's just as long as in perspective, when you start doubting the prices in this stock market, when you start doubting the prices of these companies and you start thinking, oh, it's too expensive or it's too much, you have to think about, the first steam engines were very unpleasant of a process to go through to build them. But once you had the first few ones, they were then used to dig the coal and to forge the steel to make more efficient steam engines. Essentially, the first steam engine built the second steam engine. And that is what's happening with these data centers. This is the initial phase one infrastructure, but the phase two is going to be much less costly, much less labor intensive, and much more of a value add. It's not going to come from people paying subscriptions for an LLM on their phone. It's going to come from millions, billions, possibly trillions of agentic AI token exchanges that are going to be occurring in ways and in transactions and things that we're not even thinking about now on a scale it's hard for the human brain to comprehend when you start thinking exponential. So that's that. That's just it is what it is. And you know what? Some of the best investors that people don't hear about, some of the most successful hedge fund guys, you hear about people that made the first investment into Facebook. About Peter Thiel, being like an early investor, and you hear about all these things, and they've made all this kind of money. That's great, but there's plenty of ones that don't get the notoriety. And one I followed for a very long time, and he was very early on in a lot of the early artificial intelligence, robotics, and blockchain trades and themes. And he always goes back to just do not underestimate the power of exponential growth, and don't think that you can ever overestimate somebody's ability to ignore it, because it's just something about the human brain. It's very hard to understand exponential. We can understand something in a linear way, but to understand how something can go from 10 to 100 or 100 to 1,000 like that, it's difficult to do. Which is why people say, "Oh my God, Google can't be worth $3 trillion." Or Apple. I think,
or just the market as a whole. The markets are at a high right now. The markets are high. We hear that a lot.
Yeah,
but are they?
Yeah, I mean it's a relative game, and there are ways you can measure and you can say, that maybe something feels high, but
certainly historically you can look at PE ratios and things like that. But there are periods of times where they are outside of their historical norm.
Yeah. Well, the S&P is at what's it at, 70? 7,758. That means that it has reached an all-time high 7,758 times. That's what that means.
So. Now 7,759.
Yeah. Now see, we just 7,759th time. I don't know. It's very interesting. This stuff is incredibly intriguing to watch. But sometimes zooming out and looking at the macro economy as a whole, because you're going to have air pockets and you're going to have periods of pullback. When you think about what the last 100 years looked like, where we went from horses to automobiles to space exploration to self-driving vehicles, all of these things. That's a huge transformation, but it was a bumpy ride. It was not just a smooth, trajectory up. It was bumpy. A lot of that comes from things that are outside of the control of the industries that are transforming our lives. It can be wars. It could be just economic, large-scale macro changes. It could be monetary policy. So even though a lot of times, my perspective on AI CapEx and spending and things like that can skew very positive, that's thinking about it 20 and 30 years out. You are going to have air pockets with these things, and you're going to have, periods of time where it feels like that narrative is crumbling, just for it to return stronger than ever.
Yeah. As it is with all technology, shifts and changes.
And just like Netflix was dead how many times?
Well, Netflix is a different sort of animal. I still struggle to justify Netflix, but whatever.
You still pay for it though.
That is true. Touche.
You've never canceled it.
That is true.
You've been saying you're going to cancel Netflix for like 20 years.
It's just...
You've never done it though. It doesn't matter.
Yeah, I guess so. Whatever. I have been called out. Anyway, let's talk about the economy. We had Q2 GDP come in at 1.5% annualized growth. It's down from 2.1 in the quarter, in the first quarter, quarter before that. Headline there, we talk about this a lot. This headline versus like doing a deep dive into it, but the headline would sound soft. If you stopped there, you might be concerned that maybe the economy is slowing, but you kind of have to dig deeper because you might miss the actual story there.
Yeah, you've had the slowdown in the headline can be traced to two things in particular. One is an increase in imports. An increase in imports subtracts from GDP, and a decline now in government spending. So on their own, isolated, neither one of those signal the underlying economy is weakening. In fact, an increase in imports could signal an increase in purchasing, potential further expansion in the industrial base, et cetera, and then a decline in government spending. It depends on what part of the cycle that occurs in. There's been periods where a decline in government spending has been a harbinger of good things, and there's been periods of time where declining government spending was in part to blame for what became bad economic times. So it just kind of depends on when you look back after everything's done and you look back over history and you kind of say, oh, well, maybe that wasn't a good idea or maybe it was. But those two things in isolation do not show necessarily that the economy is weakening. So that's kind of look through the headlines and get the real picture of that. Well, imports are up, government spending down.
Yeah, the private demand really is the core there. And this is a measure that combines consumer spending and the business investment, and it kind of strips out those volatile import and government components. So that number grew 3.9% in the second quarter, which is more than double the 1.7% pace of Q1. What do we extrapolate from that? The consumer has kept spending. Businesses are keeping investing. We talk about AI CapEx. A lot of that goes into this conversation as well. The economic engine here is still running.
Yeah, not only is it still running, I think that it's finally starting to run. And the proof in that is the ISM. The ISM manufacturing index rose to 55.6. We spent recession level numbers for years with the ISM that finally broke positive this year. A level above 50 signals expansion, so we're now at 55.6, the strongest reading since 2022. So production led the new gains. New orders were very solid. Factory hiring expanded for the first time in almost 3 years. Cost pressures simultaneously ease. So it could be that as far as real, tangible, tactile economic growth that both you see, touch, and feel, aside from the digital side of things, you are seeing that expand finally at a pace that can actually be meaningful to people's lives, economically, and what they bring home and the job opportunities. It's been a long time coming.
Yeah, the manufacturing sector is kind of struggles really with those elevated interest rates and reduced capital spending. But what we're seeing now appears to be a genuine recovery. The infrastructure of AI that we talked about is partly responsible. Enormous demand for data centers and chips and physical equipment showing up in the factory orders that we're seeing. Digital economy and the physical economy are more connected.
That's true.
Than people realize.
Yeah. That is true. So I think the takeaway is the headlines that we digested last week, they look okay, but the underlying economy looks a lot better than okay. That's my honest take on it. The underlying data, strip out the noise, and you're dealing with some pretty darn good numbers that I hope, continue in that direction. Now, last week we also had the Fed that held rates unchanged. It's the 5th consecutive meeting that such has been done. Second under Warsh. So you had 3 dissenters out of
meaning they wanted
12.
a hike.
Yeah, 3 out of 12. Less than what it was last go around. Remember, it was split almost, or it was a tighter vote.
The most since 2016, though.
No, I thought last time it was maybe it was 2. Whatever. 3 dissented. Okay, 3 out of the 12. I mean, it doesn't really matter what's the decision they made. The decision they made was to hold it. Now we got to get down and start looking. The
decision was no decision.
Yeah, so now we got to start looking. Well, how many voted in favor, and then what signal does that get? It either is or it isn't.
Yeah, that's a good point.
It's because this is how starved the media is for something to talk about with the Fed. Warsh gets in there and says, "Hey, listen, guys, we're not going to talk about this crap anymore. Y'all." It's nonsensical. You want to talk about what we talk about and then talk about each other talking about what we talk about. It gets to a point where it's ridiculous. Let's let the market work out, and then we'll step in and try to do the best job we can. All right. I applaud him. Okay. Yeah. Okay. That's what he said. Makes sense. We're going to stop with all the speeches every 2 days with everybody's opinion on something and just deliver the policy and let the market digest it. But now we're getting into, what were the 3 votes solidly against, or could they be swayed? Where's maybe 2 votes and 80% no? It's it just gets ridiculous.
Out of 10, how much do you want a rate hike?
Yeah, one was 6, one was 7, one was 5.5. So we're going to weight that accordingly.
Yeah. I mean, that's a good point. People are trying to find things to pontificate on because it's not very clear, which introduces necessarily a level of volatility. We talked about that too with your comparison with Greenspan and Warsh that you've been kind of harping on. We're seeing that play out in real time. And volatility is one of the things that we could expect from that. Volatility in both ways, because we're, in a new paradigm where people in the financial news certainly have to sort of be able to digest this information and then come to a conclusion about what it might mean, what all the potential possibilities are, versus being told very clearly, look at this dot plot. This is where we're going to go.
He said it plainly. He's listen, because he was asked about, rates went up. Is the private market telling you where rates need to go? He's I don't know. Maybe they are. Maybe they're wrong. Maybe they're right. Who knows? We got to watch and take that data in, because what we can't do is set the expectation for the bond market, let the bond market react, and then we react to their reacting to our initial action. It's we're basically believing our own BS at that point. So you have to cut that chain of events to where you let the private markets price things, and then that's another data point for you to help decide as the central planning committee for interest rates and the price of money in the economy, which direction you should go. Who knows? Who knows? Maybe there are other people that know better than I and reference this, but to me it makes sense. It's logical. Let the market feed you the data, and then you can make a better determination as to what to do with the balance sheet and what to do with interest rates, et cetera, et cetera. So,
the only place that potentially could backfire is the data that you're looking at, because your decision is only your decision that you have to make is only as good as the data that you have. And so, if you are the Federal Reserve and you're looking at data that is oftentimes stale by the time you are trying to make your decision, maybe that's something that he's trying to solve for. Maybe that's why, we didn't get a hike this time, is because, he's looking out further than that. Maybe he's looking at a different data set, but that's interesting too. It's a hard job. I mean, I definitely wouldn't want it, but it's something that it's just going to take time for it to play out, to figure out, does he mean what he says? And does he actually have a path forward?
It's a media circus, because pay attention to what's actually happening in the economy. And there are too many of these money managers, too many of these algorithmic setup, these algorithmic traders that will use the media circus around a Fed decision to just wreck the markets. They do it. You've watched it develop over the past. It used to not be this way. Every single time Jay Powell opened his mouth, the 9 times out of 10, you could short the market and make $1. Almost every single time. Now, this is like, if it was one time, okay, it's interesting, right? If it's twice, oh wow, it's really interesting. If it's every single time, it's nonsensical. The media plays it up because they get the attention, they get the clicks, and then the guys setting up the algorithmic trading are like, oh my God, we can make money off of this negative spin, every 6 weeks. And it just is this self-fulfilling prophecy. And then the Fed starts loving itself so much to where literally every week somebody is opining on something. And it's like, you put so much noise out there. How can you interpret what's going on in the private economy? I mean, we're supposed to be a capitalist private system that people are making decisions to risk their capital or to not risk their capital for economic gain, and that sends signals and prices all throughout the economy. Let that stuff play out and then make your decision. Don't get out and talk something, and then because of your talking, you change the price of maybe the middle of the interest rate curve, and then now the next meeting you're like, well, the middle of the curve did change, so now we're going to have to factor that in. Well, you idiots, it changed because you opened your mouth. Like, if you'd have just been quiet about it, you could have seen what the real economy was going to do with interest rates.
We'll test that. We'll be able to test that thesis for sure. But it's not only there are big market makers that have that ability too, that they'll put out guidance that says, for example, we had a big one last week before the Federal Reserve made their decision that said that they were going to hike. Like, we're certain that they're going to hike. And that had an effect on the markets, the way the markets moved.
Well, that's fine if you believe such things, but who
believes them?
Whoever released
they can't have believed it.
Somebody did, but whoever releases those types of statements they don't have the ability to print trillions of dollars out of thin air. So when the Fed says something, it's much different.
It's true.
Than with Joe Blow analyst at XYZ firm says something because he's talking his book.
Well, I'm not making a comparison between the ability. I'm maybe making a comparison between the responsibility, I guess, of those things happening independent of each other. But, it is what it is. I mean, we're in a new paradigm here, and we got to kind of figure out how to pivot from that. But September meeting, is still going to happen. Markets are currently pricing around a 60% probability of a hike. We'll see how that goes. We know kind of the view that we have here on this show that we've talked about a lot, which is that we don't think that's going to happen. You look at all the data that they're going to get between now and then. You talk about inflation reports, jobs numbers, oil. All of that is going to be encompassed in that decision. And the closer we get to that September date, the more those things move. And you also have to remember we have midterms coming up too. So the more those things move in the opposite direction, which I think is what the sitting administration would prefer to happen, that data is going to change and it's going to shift. And in 2 weeks it may not be 60%, maybe 40%, or maybe 45% or 35%, or whatever it is. So it's not necessarily like a guaranteed thing, even at a 60% probability of a hike. You just have to take it as it comes.
Yeah. Yeah. Well, let's get into the planning room. This week's topic is one that we've teased a couple of weeks ago, and we wanted to spend real time on it because it's genuinely important and it flies under the radar for most regular investors. I would venture to say most people listening have not even heard what we're about to say.
Well, if they listen to the show, they would have.
I'm out of my Coke Zero and I see it sitting over there. It's staring at me.
That's not Coke Zero.
It's the Sam's.
Don't say it. They're not a sponsor of the show.
Sam's version of Coke Zero.
Yeah, when we talk about tokenized deposits, let's just say, going back to that conversation about the economy and big tech earnings, and we talked about a couple of weeks ago, JPMorgan had its best quarter in the history. Goldman Sachs was the same thing. The banks' record results were not just about trading revenues or IPO fees. They're also about their potential role in the future digital transformation of financial markets. And that's happening real time now. They're setting the framework for that. So that's kind of what we want to talk about with this conversation. But also, 2027, 2028, 2029, 2030, these time periods are going to look very different for what, financial technology is going to look like and the way your money moves around.
Give us a baseline example, simplest explanation possible for when you're, because, I think the feeling is out there for people that think about these large institutions that have really kind of been sitting, they've been innovating, they've been reinvesting, they've been kind of very quiet through a lot of this blockchain AI, just efficiency gains that have happened in other areas of the economy. They've been very quiet, even though some of the regulatory changes have been very favorable for them. So give us a simple example. So
before I get into that, this is not going to be a crypto conversation. So let's just get that out right now, because people are going to maybe potentially think it could.
You want to bet?
It's a conversation about how biggest banks in America are quietly rebuilding the way that your money moves. So think about your bank account today. You got maybe $50,000 at the bank. The bank records that on its ledger. It's essentially a digital spreadsheet that says you are owed $50,000. And when you want to send that money to someone, the bank will process that transaction. They'll update their ledger. Eventually the money will arrive. Sometimes it's seconds, sometimes it's days, depending on the type of transfer you use. There's all different kinds of Zells and Venmos and all that kind of stuff that moves money quicker if you pay fees for it. But yeah, it's that's basically the process.
So think of it as a fairly, well, not really even complex, but we could say, for the sake of the discussion, a complex Excel sheet. That's what the bank is. Managing IOUs between person A and person B, or person A and themselves as person B, so forth and so on. A tokenized deposit is, instead of it operating on that Excel sheet, it's same FDIC insured entry into the ledger book, same legal relationship, but it exists as a fungible digital token inside of an immutable blockchain. So think of it as an Excel sheet that cannot be altered, changed, or messed with. It is automatically populating and automatically depopulating based upon the input of the depositor, not on the operation of the bank. So it allows funds to move faster at any point in time. The time of day is irrelevant. Automatically, again, it's being flipped on or off based on the depositor, not from the employee at the bank saying, okay, well, this paper was placed at this branch, matched to this deposit slip, ergo everything balanced at the teller's bucket of money, whatever, the drawer. Mm-hmm. And so the deposit must be true. And then we will update it into the bank account. There's your IOU, et cetera, et cetera. All automatically, much more flexibility. It's a big deal. It's a big deal. This is just breaking into tokenized real world assets when we're talking purely about tokenized deposits.
Yeah. I mean, if you think about, when ATMs were first introduced, it didn't really change the way your money worked. The dollar in your account was still the same dollar. The only thing that changed was how you could access it, how you could move it. You could go on the weekends and pull money out. Tokenized deposits are similar. So the money is still the same. The infrastructure it runs on is being upgraded. So to your point about it doesn't matter what hour of the day it is. It also doesn't matter what day it is. You could do the same transaction on a Sunday that you would normally have to wait till a Wednesday morning at 10 a.m. to do. And, the concept of depositing a large check and having it held or something like that is maybe, going to be a thing of the past soon.
Yep.
with this as a result of this kind of technology being adopted in the future.
Yeah, and these tokenized deposits are a validation of the value creation potential that exists within the world of blockchains, or the world of crypto, as it's also has become known. But I like the term blockchain because it's more descriptive of actual valuable pieces of technology, whereas crypto is more kind of brings up the meme coin and those types of things.
Yeah.
So
that's why I said it's not necessarily a crypto conversation. I mean, we can talk about the underlying, technology of it in a minute, but that's just at face value.
Yeah, because you got Bank of America, JPMorgan, Citi, Wells Fargo, Goldman, and more than a dozen others that are all working. They either have their blockchain infrastructure that is their own design, or are using a public blockchain to get these tokenized deposits to move between banks. And they're building this because at the end of the day, when you create a tokenized anything, doesn't matter what it is, you're making that thing programmable. So here's an example. If you're a large company that needs to pay a supplier when goods arrive, say at your industrial warehouse, today that involves a purchase order, an invoice, a payment approval process, a bank transfer, multiple people, multiple systems. Every single one of those adds time and adds cost. Whereas on a tokenized asset, you can program that payment directly. The moment the goods arrive and scanned in by your receiver at your warehouse, the money's released. It's all smart contract. It's all pre-programmed. Yeah. So, and it's instant, it's automatic, no one approving anything. The payment, the transaction happens simultaneously. And that's what's called atomic settlement. Asset moves, the money moves at the same time. That's a big deal because for large companies, the kind of efficiency at that scale is transformative. It removes friction from the financial system. It frees up cash that would be sitting, idly by for a week at a time, waiting for settlement cycles, and it puts that cash to work. And that is a big deal. You would think that, this company's $1 million in purchases sitting for 7 days idle isn't really that big of a deal for the economy. Take that, times it by 1 million, and you're looking at hundreds of billions of dollars that can be immediately start to be free flowing. And the velocity of money has just as an important impact on the economy as the quantity of money does. So how fast that stuff moves through the system is a big, big deal.
It's primarily what we're seeing now is more an institutional story currently. So that's corporate treasury, cross-border payments, securities settlements. The checking account that you have at your local branch isn't going to become a blockchain token tomorrow or next year. The infrastructure being built at that institutional level today eventually becomes the infrastructure that the entire financial system runs on. So that's why we say looking out past, maybe 2028, maybe beyond, then you start to see this kind of drip down into the retail, maybe sooner than that, depending on who you bank with. If you're banking at one of these larger banks that feels like they can pilot this program efficiently and effectively before some of the other ones, think your JPMorgans and your Citigroups and your Goldman Sachs, all those banks, they may be kind of at the forefront of that.
Yeah, I mean, well, let's go down and tell us a little bit about the infrastructure question about the how, when we say the words tokenized deposits or we say blockchain technology, people are going to naturally ask, like, well, what token is behind that? What coin is behind that? Or what is JPMorgan functionally doing? Mm-hmm. Let's add some context.
Well, the blockchain infrastructure question, I guess. There's kind of debate about this in the financial markets right now. JPMorgan put its deposit token on a network that's called Base, which is built on Ethereum's technology. BlackRock's tokenized money market fund exists on other blockchain infrastructure. The question of where that economic value accumulates as they move to these digital rails whether that's the bank themselves, whether that's blockchain networks, whether that's other intermediaries. Those are kind of up in the air at this point. But we are seeing a lot of focus on Ethereum, I guess, is a lot of where that concentration is going to.
Yeah, I mean, I would say Ethereum in particular, especially as a part of tokenized assets, is a part of this conversation in a way that's different from most people think about crypto, because it's not being thought of in a speculative way. It's being thought of as infrastructure, the infrastructure software that allows at scale, large, immutable, trustless transactions to serve the everyday needs of the economy. So when you see JPMorgan putting a deposit token on a network that is tied to Ethereum, that's a much different signal than the average Joe buying whatever coin,
Trump coin,
whatever coins that are there, there are thousands of them.
Yep.
And I'm not mad because I'm sure that somebody, I've seen it on Twitter or whatnot. You get somebody that puts $1,000 on Mars token, and it goes up, and now they're like worth $20 million. I'm not hating on it. Good for you. Go get it. But
this is not that.
That is the exception. Not the rule. For every one of those, there's 100 million other people that just buy some garbage type token that's just what we call a rug pull. And that gives the industry a bad name, but you have to understand those things, while plentiful, there are a plethora of those nonsensical things. The overwhelming 99.99999% of all of the value in cryptocurrency is in the top infrastructure and store value plays.
Yeah, you want to see that the technology is actually being put to legitimate institutional use. And this is a really good way to look at this in what could potentially be kind of an early view of it. Because, when we're looking at investment implications, those are still emerging. This financial system where tokenized assets are coming to play, it's still being built. Companies, they're building the protocols, they're wanting to capture the most value that they can from this technology. Those transitions are not really clear. But what is clear is that the biggest banks in the country are spending real money to build real infrastructure based on real underlying technology, crypto technology, blockchain technology. And investors who understand that direction sort of have an advantage if they can ask the right questions about it. That's all. Correct. It's all about asking the questions.
Correct. And you can't be intimidated or scared out again because you hear of these esoteric names and these weird little crypto projects run out of India or something. You got to ignore that, and you focus on, first of all, you work with an advisor that knows what they're talking about when it comes to these types of things, but you got to focus on the bigger projects, where the actual money is at, where the actual value is at. Out of the $2.5 trillion crypto market, again, 99.99% is all accretive to the largest projects. And these other things, you can't let it distract you, because it would be like ignoring Berkshire Hathaway stock because Pets.com didn't make any money in 1999, right? They were both stocks, but two incredibly different projects, right? Pets.com had no revenue. It's just a website, basically. And Berkshire Hathaway, we know, has gone to become one of the largest conglomerates on planet Earth. So yes, I agree, and I think you put that very well in saying that when you see JPMorgan, Jamie Dimon was reluctant to embrace anything crypto until he understood its potential. And now that he understands its potential, you see them using an Ethereum backed token. What does that mean? Ask the right questions. And, a lot of times, especially with these large companies, if they can do anything that, will make some sense, it's going to make them some serious dollars. And that's why they're embracing it.
That's why they do anything they do. And so, it's an interesting thing to look at. If you have meaningful exposure, the practical takeaway here is if you have meaningful exposure to any of the financial sector, if you have an advisor, ask your advisor about the firms that you own and if they're positioned to do well in financial infrastructure change and in the digitization of that. And if you've been curious about blockchain or digital assets from an investment perspective, the tokenized deposit story is really a grounded entry point for anything in the so-called speculative crypto market.
Yeah.
And if none of that applies to you right now, at a minimum, just understand the way your money's being upgraded. And that upgrade has already started in the back.
Yeah.
In the back of this, all of this, and it will eventually trickle down to how we think about it.
I think it's great advice. Always talk to a trusted advisor, and if you don't have one, go to momentumwealth.us. We'd be more than happy to speak with you about our perspective on blockchain technology, where it fits into your portfolio, the projects that we believe give you the greatest blue chip exposure to growth in that space, so that your portfolio can be future proofed with these technologies that are disintermediating several aspects of how the financial markets work. They are removing the middleman, and every time in history that has occurred, significant value creation has also simultaneously occurred. And so the upside, the potential is huge. The ability to have a right-sized proportional allocation to, again, future-proof your portfolio is something you at least need to consider and think about. And that's something that we're seeing some of the largest institutions dealing with wealth management on planet Earth have already done and are doing. You're seeing whether it be 5, 6, 7, 8% allocations to some of these projects, whether it be Fidelity speaking about, Bitcoin allocation, future-proofing your portfolio, whether it's Vanguard, who swore they would never, ever allow blockchain technologies on their platform, and they are actively doing it.
Well, they had a leadership change.
Been a narrative shift.
Some people say because of that.
Yeah,
but
big narrative shift. And
again, this is a long-term focus. This is how we think about these things when we're looking at investing. We're not short-term investors. We're long-term investors. So we look at things that, not necessarily looking at them the way they are now, but what they could be in the future. And that takes a bit of discipline to be able to sort of skate to where the puck is going to be.
Yeah. It absolutely does. Well, listen, we were at all-time highs, AI earnings. It just keeps surprising. Strong economy underneath. Everything is getting into this quarter just as we would like to see it. And we'll keep you updated. We spoke about tokenized deposits, and I know it's hard for us to get real in-depth, but as we work through the rest of this year, as we see if the Clarity Act becomes law, we could have some pretty interesting and exciting topics concerning tokenized real estate, tokenized stocks, tokenized bonds, and what that means as well. But other than that, I think that we've talked everyone into ready. They're ready to turn off the podcast.
Yeah, we went long. We said we were not going to go long today, but we did. So sorry about that. That's good returns.
If you're still with us, we appreciate your patience.
Well, that's been good returns for the week. Thanks for spending time with us. Hope it leads to good outcomes. Hope if it sparks any questions, let us know. Be sure to subscribe, comment below if you have a question or anything. Subscribe if you haven't. Share with somebody who you think would find value in it. And we will see you back here next week.
Yeah, absolutely. Everybody take care.
Bye-bye.